All right, hey, how's it going, everybody? My name is Amos, and I was supposed to take a rest day today and just hang out with the wife. But it's a pretty important earnings week. There's a lot of heavy hitters, as you can see on your screen right now, that are reporting their financial performance in the past 3 months. So I had to do it. I had to film this video, and I'm doing it before she wakes up. That way she doesn't know I did it. But let's go ahead and talk about some of those companies. So on Monday, to kick things off, we have the only one that seems to be important to me is Fastenal. Now, I previously worked in the supply chain and logistics industry, and this is a really big player in supplying the random parts, and they even operate vending machines where you can swipe your card to rent out like gloves or whatever supplies you might need. And for the longest time, I ignored them. But after getting to know this company, like beyond the surface level, look at their numbers, okay? And check this out. If we jump over to their dividend profile, by the way, this is going to be a more laid back video. And I have the camera off because, to be fully transparent, I look like a bag of ass right now. I am so tired and sore. Number one, I've been doing marathon training. So I've been running, so my body is run down. But I've also been going like 120 miles an hour with my various YouTube channels. So I'm kind of mentally tired as well. But anyways, if we take a look at their dividend profile, okay, this does not look too good. What in the hemoglobin is going on? Their dividend growth rate is negative 11%, 2% dividend yield, 82% payout ratio. What is happening here? Wait, how exactly is it going down by negative 11% if this looks visually really pretty? Maybe we're not seeing something. Let's see. No, they're actually growing their dividends. I don't know why this says negative 11%. That's actually inaccurate. So dividend profile checks out. The top line looks pretty good. And their stock market performance is pretty good, 100% in 5 years. So this company I'll be keeping an eye on. I add and delete them from my watch list depending on my mood. But Fastenal Company is pretty... I feel like it's slept on. It's an underrated company. Let me go back to the earnings tab. So that's Monday to kick things off. That's the only one that I would say is important. Although on the visual picture that I showed you guys, I think there's other ones, but we'll just leave it at that, Fastenal. And as we jump on over to Tuesday, July the 15th, the reason I had to make this video is because the big banks are reporting their earnings. And the financial banks, such as like JP Morgan Chase, Wells Fargo, Citigroup, it kind of gives you a preview, but also a pulse check of how the economy is doing. If businesses are thriving and are booming, so will the loans, the lending, so will the banks be thriving. But if the banks report poor or they give really scary guidance like, guys, I don't think things are going to be going too hot for the rest of this year, the rest of the stock market will sell off. I'm being dead serious. And that's why, even if you are not invested into these financial companies, you might want to pay attention on Tuesday. So JP Morgan Chase, I think pound for pound, I made a ranking video for the banks industry, and JP Morgan Chase, I believe, is probably at the top of that list. By the way, you should go watch that video if you haven't. But let's see. Their revenue estimation is supposed to go down by negative 13% year over year. And their net income per share should be positive by 2%. So the expectations for JP Morgan Chase is pretty low. The bar is pretty low. It's kind of like Nike. I remember they were telling everybody like, dude, we're screwed. And then when they posted their earnings not too long ago, they weren't as screwed as they implied. And so their stock price exploded, even though it was really bad. So I guess that's kind of what's happening with JP Morgan Chase. Wells Fargo, BlackRock. Dude, BlackRock pretty much owns the entire world. They're invested into almost every business and publicly traded company. Citigroup, the Bank of New York. These are all the heavy hitters in the bank industry. That's scary. And then there's Albertsons Companies, right? This is a grocery chain that operates in the US. I feel like their only real competitor is Kroger, to a pure play in the grocery space. Because I think Walmart, I think 50% of their revenue is generated from the groceries, but they're not a pure play grocery business. And I always tell people, like, if you win it big in the stock market, don't keep gambling. Right? You want to pivot and transition that money into something that's more safe, slow and steady, like a grocery stock. And I feel like Albertsons, Kroger's, and Sprouts, organic markets, they should be in that conversation. And I mean, it's nothing to write home about, right? Like 51%, but the dividend is pretty reliable and steady. Growth rate is 12%. This is a company that I would not invest into unless I really had to. Like if I was retired and I kind of wanted my money. Think of grocery stocks as kind of like a proxy to bonds, because the financials check out, right? They grow slowly year over year. There's no real red flags, except if I do jump on over to their, hold on, let me look at their net income. Their bottom line is positive. If I do jump on over to their balance sheet, I imagine they do have a lot of debt. They have $360 million of cash on hand. Total debt, say, yeah, $14 billion. So after you use all the cash and cash equivalents, $360 million to pay down how much loans you have on the books, you still have $13 billion of loans. So that is something to be mindful of, but it's just the nature of the industry. It's nothing to be scared about or to say, oh, the grocery stocks are trash. No. Even like the trash companies, like Republic Services and Waste Management, they have a lot of debt on the books, but they're still very high quality and their business model prints cash. Debt in itself is nothing to be scared about as long as it's manageable. And then let's see if there's anything else that's kind of crazy. I guess this would be another status check of how the economy is doing, because it's like a trucking company. If there's more trucks that are operating and in demand, that's just the economy thriving, right? So this is another heavy player that Wall Street analysts are going to be paying attention to see how, I guess, year over year or quarter over quarter, are there more trucks in the road or not? Would I ever invest into them though? Probably not. Not really my cup of tea. Rather than the trucks, because I feel like the trucking industry, like my dad is a truck driver, right? I don't talk to him, but he's a truck driver, and I feel like they're a super crucial ingredient of the economy. Because without the truckers, dude, the U.S. would not be what it is today. So they're very important, but in the transportation sector, I would rather invest into the railroads, because I just feel like it's a little more steady, right? It's with the trucking, I feel like there's ebbs and flows depending on the shipments, depending on the client demands. But the railroads, no, regardless of the load or how much demand, they're always moving gear. So I would rather invest into the railroads, but that's just me. Let's go back to the earnings calendar. By the way, on my day off, I'm probably going to spend more time going into the rabbit hole of researching about the Kimber Rouge. So this morning, I spent like 15 minutes reading the synopsis of like what exactly is the Kimber Rouge. And, you know, you can call me an ignorant American, that's acceptable. But I had no idea that happened. So basically like in the 1970s or 60s or whatever, during the height of the Cold War, apparently like Cambodia had like this regime change and it became communist. And there was this dude named Pol Pot. And dude, he was committing genocide basically. And it was a horrific history and a timeline for the Cambodians. And that's what happens when somebody has a tiny wiener and he takes it out on humanity, right? Just because you have a small ding dong doesn't mean you got to go unaliving your fellow neighbors. You know, I also think about Adolf Hitler, right? You got a tiny dong and you got to take it out on other people. It pisses me off. And that's why when people say, oh, the U.S. military, you guys are evil. You guys are slaying babies. You guys are heartless. It's like, no, that's not what we're doing. And at the end of the day, I support the military, because without the military, who's going to put an end to evil, horrific, demonic creatures that call themselves human that commit crimes, right? I feel like the military is a necessary evil. So it is what it is. But come to find out, I mean, I only spent like 15 minutes, but apparently the Vietnamese raided and invaded Cambodia and liberated them, which is pretty wild. Because Vietnam, dude, when you think about it, they're pretty much undefeated. They beat the French, they beat the Americans, and they beat the Cambodians. So big props to Vietnam for, helping the Cambodians survive that terrible era. But anyways, I'm going to do more research. I'm going to listen to some podcasts and see what all went down during the Kimber Rouge. By the way, did I tell you this is going to be laid back? There's no script. This is something that I do every Sunday, right? I look at, or I guess it's Monday, but I look at the upcoming anticipated earnings to see like what's going on for this week, just to stay up to date, just in case, like if something goes like negative 20% of my portfolio, at least I know why that happened. And so I decided, why not record it, right? Maybe someone out here will appreciate this as kind of like a podcast format. What else do we have on Tuesday? We also have Hancock Whitney. I believe they're in the business of avionics and like aircraft parts, and I guess like a parallel play to the military industrial complex. No, completely wrong. Hancock Whitney Corporation is a bank that provides, dude, I was so wrong. Who am I thinking of then? The name sounds like this, but they do something related to aircraft. Hold on, I gotta look this up. It's gonna bother me. Hancock Whitney aircraft and parts. Oh my gosh, I am so dumb. So that's Pratt and Whitney. So the company that I was talking about is Pratt and Whitney. This one is a bank apparently, and it's a regional bank. Where do they do business? For Mississippi. Is that basically what they do? Let's see. They provide banking services for, Mississippi, Alabama, Florida, Louisiana, and Texas. Okay, interesting. So I guess almost all the banks are reporting this week, big and small. Let's jump on over to Wednesday to see what else is going on. By the way, because I'm prepping for a marathon, my body is just perpetually sore. My calves right now, dude, I can't even get up after sitting. So I have a standing desk that my wife and I made. So I don't use a chair, essentially. Sometimes I use like a stool if I'm super tired, but I'm standing right now and I'm struggling. But anyways, Wednesday, what else do we have? We have Johnson & Johnson. This seems to be like a dividend investor's favorite. I see the hype, but not into it, right? I also, besides the supply chain industry, I also used to work in the pharmaceutical industry as a strategy director. And I guess based on my experience and seeing stuff behind the scenes, I'm just not bullish about the pharmaceutical industry. And it looks like Wall Street is anticipating for their bottom line per share to decrease by 5%. So I guess the expectations for J&J is pretty non-existent. We also have Bank of America, ASML. Dude, this is going to be huge. And I feel like they're going to crush it because I feel like every single one of the AI semiconductor chips, AMD, NVIDIA, TSM, but also the ones that build and sell the equipment like ASML and Lam Research, everyone's crushing it. So I would be surprised if they don't crush their earnings. And wow, if you bought into them during that April sell-off, let me see what their 1 month return is. It's only 2%? No, but that only goes back to June. I guess we would have to year to date. But I want to know what it was from April to... Here, let me do it on my other screen right here. ASML stock. So if you bought in right here at about $5.95 April the 5th, let's see. It'd be a 24.5% return. Not bad. Not bad. But I feel like, I don't know if you're anything like me, but I think this price is pretty darn steep. So thank the good Lord there's such a thing as fractional shares for most brokerages. But man, $800 a share. That's pretty steep, but it is high quality, and it makes sense why someone would want to invest into them. But let's go back to see what else is happening on Wednesday. Morgan Stanley, Goldman Sachs, my goodness. These are some heavy hitters in the investment banking community, but also for the financial sector as a whole. And the expectations are pretty darn high for them. Man, those are pretty big shoes to fill. And then there's Progressive Corporation. This is a video that I spent a ton of time researching for the insurance industry ranking video that I just put out. And this one I am definitely hoping that I can buy into. But the expectations seem to be bonkers. 54% increase year over year for their net income per share. 18% for their revenue. My gosh. The expectations are super high. Can we do this by quarter to quarter? Because I mean, it looks pretty darn good from what I can see on an annualized basis. But if we break it down to a quarterly basis, let me see how they're doing. Oh my gosh, they have been crushing it. So in the past Q1 2025, when they reported their earnings on March 31st, they increased their total revenue by 18%. And I think they increased their margins because, let's see, EPS increased by 10%. So the expectation for it to increase by, what was it, like 50% or something? That's ridiculous. Which in 2024, dude, Progressive was killing it. They were increasing their net income per share by 400%, 300%, 100%. So it does seem to be coming back down to earth, more reasonable levels, but my gosh. By the way, I'm so close to releasing that insurance stocks ranking video because I think the deal that we made is if the video gets 200 likes, which is nowhere near that. I think it's a little over like 80 likes. Or if we get 3 people to join the Patreon. And since I uploaded that video, we lost one person because their financial situation changed. And I understand that. That makes sense. But 2 people ended up joining. So if one more person joins the Patreon, I'm going to drop that insurance stocks ranking video. And Progressive is on my watch list for a pretty good darn reason. Their dividend profile, nothing to write home about, but yeah, that's all I'm going to say. Look at that dividend growth. And in that video, I do explain why it says 300%, but there's a lot to like about this. However, I am a little concerned because what was that expectation? Dude, I have the brain of a peanut right now. I'm so freaking tired. What was it again? Yeah, a 54%. Dude, that's... So if they report like 50% increase year over year, I think that they're going to go on a sell-off. And I don't want to be a negative Nancy, but I'm hoping they do go on a sell-off so I can buy into them. Because if we take a look at their 1-year metric, it looks like the lowest price they did hit was around 207, but it does seem like 200 might not be out of the realm of possibility. I think they could hit $200 a share. And if they do, I am snagging Progressive. A 200%, just from their share price appreciation, 200% in 5 years, 2x your money with a silly old traditional insurance. So, yeah. There's Prologis. I believe they're a REIT that rents out warehouses for people that operate in e-commerce and anything in the industrial space. This is a dividend compounder with cheese. I covered this company in the REIT ranking video, and a few of my colleagues that quit from the supply chain company that I was working for, they hopped on over to Prologis, and I guess that's what put Prologis on my map. And once I got to take a look at their numbers and stuff, they're pretty darn good. I mean, their stock market performance is absolute trash because obviously the REITs have been just getting pounded. But as a business and as a REIT, I think Prologis should be on people's radars instead of Vici. There's so much infatuation with Vici, but I just feel like it's a bubble because they only operate in Las Vegas and they only operate casinos and hotels in Las Vegas. If Las Vegas ever comes crumbling down, or if people decide to not go to a casino, yeah, Vici is screwed. Because I feel like they're not spreading, they're not distributing their risk. To be only siloed in Las Vegas, Nevada for your real estate portfolio, I just can't get behind that strategy. I mean, Vici does post good financials and they do have good numbers, but you have to keep in mind their origin story was from a bankruptcy or like a really big financial catastrophe from their parent company, and that's why they had to spin them off. And that's how Vici came to life. So they were born from the ashes of a financial disaster of a situation. So with that kind of a timeline, right off the bat, I'm kind of like, dude, that's like a yellow flag, man. You might want to brush your teeth, my brother. All right, but anyways, what else do we got? We got M&T Bank. I actually interviewed for an investment banking position with these guys during my MBA. So did a whole lot of homework for them. And let's see, their expectations, not too crazy. United Airlines. Dude, the other day, I was looking at, here, I'll pull this up. I was looking at American Airlines just for fun. And dude, their stock price went to the moon like, hold on, let's see. Yeah, it literally went from $11 to $12.91. And I was like, what the heck is going on? So I guess if American Airlines is any indicator of how the airlines are doing right now, they must be crushing it. But I guess after it popped like that, actually, let me get a more accurate depiction of that gain. Let me see. So it was a 12.5% gain from here to here. I guess some people that were bag holding sold out of it because I guess in the past 5 years, you can see that American Airlines has a pretty predictable pattern. It's just like Ford. I made a deep dive video for Ford and I forgot what I said at the end of the video. I was like, if you buy at this price and you sell it at this price, you can rinse and repeat the cycle again and again. But I think of American Airlines, I mean, I haven't done that much research on them, but that seems to be the case as well. Like buy into them when they hit below $10 and sell when they hit above $12. Easy money. Or maybe it's not easy money. Let's see how United Airlines. So United Airlines seems to have that same kind of pattern. Their highs and lows on a pretty predictable basis. But then for this year, dude, they've just been popping off. Airlines are okay. Their valuations are pretty low. But I think it's one of those industries where the ROI for their CapEx is just not worth it because the planes are constantly being repaired, maintained, and there's inventory turnover. You can't just keep flying the same plane for 30 years. You have to replace it. And I think there's just way too much money that gets spent in order to make money, where for me, it just doesn't make sense. Because, check it out. If we take a look at their free cash flow, yeah, this is pretty horrific. I mean, during the pandemic, it was negative $5.8 billion. And I guess right now they're in the high cycle because I guess the economy, despite people being, saying stuff like, oh, we're doomed, we're in a recession. I mean, the fact that an airline is crushing it like this, it must seem that people are okay with paying a premium for their flight tickets right now. So I don't know. I'm just not interested in them. They don't even pay a freaking dividend. Can we just stop talking about United Airlines? Okay, let's see what else we got. Oh man. Let's see. Oh man, here's Rexford. Here's a company that I bought into during their sell-off this year. I bought into them when they were like $30-$31. And I'm in the green by a little bit, but this is a industrial REIT that owns an entire portfolio of only Los Angeles and SoCal-based factories, warehouses, and stuff like that. And you might be like, dude, California, that's stupid. But believe it or not, California's economy and GDP is more lucrative and generates more cash than a whole bunch of different countries on the map. So I'm not bullish about their tax rates and some of their policies towards small business owners or even the big corporate businesses, but I am bullish about California. But yeah, past 5 years, absolutely crushed alongside with all the other REITs. So yeah, if they do go on a sell-off and their stock price goes below like 32, 31 bucks. I guess I will dollar cost averaged. And yeah, their EPS estimation, negative 35%. No expectation at all for this company from Wall Street. Let's see, some more banks. Another REIT. Anything crazy here, guys? Just banks. Okay. All right, let's move on over to Thursday. Looks like there's 29 companies. Netflix. Wow, the expectation is that their bottom line per share is going to grow by 44%. Dude, that's wild. But I think it makes sense. They've been crushing it these days. Past 1 year is an 83% return. Yeah, it's absolutely wild. I think that's why I know a lot of you guys are not a fan of Disney, but I think once Disney hammers down their political agenda and just get back to making good content, I think through their streaming, because think about it, right? Their intellectual property and their portfolio of all the different franchises, like the Star Wars, the Avengers, and like the Disney princesses and stuff like that, so much potential. And if Netflix, who only does streaming, is crushing it this hard, imagine when Disney catches up, right? Once they stop playing games and they just focus on making a good product and service, I think they're going to crush. And along that same conversation, I think about Apple as well, because I think a lot of people are bearish towards them right now because they only associate Apple with the iPhone, right? And of course, the sales are slowing down because I think, dude, to be completely transparent, as a guy who is invested into Apple, they're falling behind the competition. Like Samsung is just crushing them in terms of smartphone technology. Like they have phones that can fold, for crying out loud. iPhones don't even give that. I think their phones are still 60 hertz for the display. Like that's a bag of pubes. Terrible. But I think where I am bullish about Apple's future is their, what is it called? Apple Plus, their streaming service. Dude, some of their TV shows are so freaking good. Like Severance, like that one World War II aviation pilot series. What else do they have that was? Hold on, let me pull this up. I don't have Apple Plus, but let me see. Foundation. Don't they have that one soccer show where it's like an American dude who buys a soccer team? Silo, Sea, Monarch, Blackbird. Never heard of any of these ones, but let me see. I told you guys that this video is just, maybe it was better if I just continued on with my rest day. Oh yeah, Ted Lasso, Masters of the Air. That's the one I was talking about with the World War II pilots. Pachinko. Yeah, dude, Apple Plus slaps, dude. I think their catalog of offerings is just getting better and better. So that's what I'm bullish about with Apple. They're streaming. And then Pepsi, right? I feel like the other CPG food stocks that have been reporting their earnings have not been too hot, but it's not as bad as I anticipated. So I'm assuming that Pepsi is also going to be shrinking year over year, but not at like a catastrophic level. I think they're going to be down year over year by like -1 or -2%, if I were to make an educated guess. But let me see what the estimation is from Wall Street. Oh my gosh, Wall Street for revenue, they're saying negative, we'll just say 1% by rounding up. But their net income per share, they're anticipating negative 10%. Their margins should be squeezed right now because the inflation costs to ship and to make products. That makes sense. Pepsi is just one of those companies where I have been putting my money where my mouth is and I have been dollar cost averaging. But I think it's one of those things where I'm at that point where I'm just going to let it ride. Like, I don't think Pepsi is going to go bankrupt anytime soon, but I feel like there's other opportunities in the stock market where the money can grow in 2025. I do think Pepsi is going to grow in 2026, 2027, and beyond. But in 2025, as you can see, it's just been, you know what I'm saying? I feel like the cost of capital and opportunity cost, I feel like if I'm going to dollar cost average, I would rather dollar cost average into Rexford Industrial or to buy into Progressive. Because, I don't know, this is just, but maybe this is recency bias. Because, as you understand, 2025 is just the era where everybody is rotating out of CPG and value stocks. For crying out loud, even Procter & Gamble, they're hovering around their 1-year low. Take a look at that. I've been buying into Procter & Gamble as well. And everybody has been rotating into the AI space again. So that's what's hot again. So, I don't know. I guess I'm weird. I like to buy into high-quality dividend compounders while they're out of favor, while they're ugly, while they're smelly. Because I know in the grand scheme of things, they'll be okay, right? If you zoom out and take a look at Procter & Gamble's total stock price chart, I'm basically buying them right here in the year 2000. With due time, they're eventually going to reach a new low, and then of course they go back on their little sell-off. They go, and then they reach a new high. I would rather buy them as they're on a clearance discount, but that's just me. But I understand why some people would rather pile their money into something that's overpriced and is expensive because it's has the hype and momentum like Tesla. Which I don't know if I can ever make that executive decision to be like, forget fundamentals, forget the financials. I'm going to be investing into Tesla despite them posting numbers that are very similar to like PepsiCo, where the revenue growth is pretty much flat year over year. And yet people are okay with the fact that Tesla has a forward trading multiple of a 160. It just doesn't really make sense to me, right? If the revenue was crushing year over year at a rate of like 50%, I think the 160 PE ratio would make sense to me. But to my smooth, pea-sized brain, I just don't see how that's justified. Well, maybe their free cash flow looks better. Okay, yeah, so they're generating a lot more cash. So I think that's why Wall Street is probably very bullish about them. I mean, to increase your free cash flow by 400% year over year, that is pretty impressive. But I think Elon Musk, I mean, it doesn't matter what your political stance is. I think he did shoot himself in the foot by alienating his main customer base, because I don't think MAGA buys EVs for the most part, right? So by him becoming super politically aligned with the current administration, I don't think he did himself any favors. Because I remember at the end of last year and ramping up into 2025, there were so many boycotts and protests going against him. It's like, I don't know, man. If you want to do business, you gotta keep your political agenda away. And I think that's why Walmart is a slow and steady compounder. Because like Target should not be suffering as hard as they are right now. It's just that Target made the grave mistake of trying to play both sides of the political aisle, and now nobody wants to shop there anymore, right? But with that said, I will buy into Target if they go below $90 a share. But I guess the big takeaway is you don't need an MBA to know this. If you are a business owner or you operate a business, stay away from politics. Stay neutral. So, I mean, the fact that they still have a 160, it just shows you the people that are invested into Tesla. I mean, with an 80 million shares volume, that's just absolutely bonkers. It's almost like a cult. And believe me when I say this, I'm not talking trash about Tesla. Given the opportunity, I would absolutely buy and own a Tesla. Which, by the way, just for fun, you know, like one of my dreams in life is to have and own a home one day, right? Never owned a home before. Sometimes I look at houses on Zillow.com just to see what the real estate market looks like, just for fun. And for the past like 3 months, I've also been, I guess, car shopping for fun. I don't have a car. I ride a bicycle around Japan. But yeah, I've been looking at used Teslas, and my goodness, you can get like a used Model Y for like $25,000. And it'll be like a few years old with like 40,000 miles on it. But I think at that price point, it might be hard to resist buying a Tesla. So if you are in the market for an EV, I would look at the used Tesla cars that are like 2023, maybe like 2022. I heard that you shouldn't be looking at any Teslas older than 2021 because apparently like the batteries and the innovation and the tech inside changed so much that it'll make the driving experience night and day to go with one that's more recent. Anyways, what else do we have? Centus. Dude, this company prints cash. Can I show you this? 18% year to date. Whoa, 20% 1 year. 200% in 5 years. I have a few buddies that after they left the military as like a captain or as a major, they end up joining Centus. I think they really like hiring military veterans. And they're basically in the business of uniform rental and facility services. They help out, I guess, waste management companies. And it's not a sexy business model, as you can see. They flame-resistant clothing, mops, maps, and they sell towels. Okay? But this company prints cash. That's why I'm saying it doesn't matter what industry. I think there's some YouTubers and some people that only want to invest into software as a service or tech companies. But even beyond that, there are so many high-quality dividend compounders in every single sector and industry. You don't have to be a tech company to be crushing it. As a matter of fact, right now I'm working on an HVAC industry video, plus another one that I'm working on is the power utility stocks. And based on my preliminary research, dude, they print cash and they're high quality as well. And that's why when people say, oh, it's so hard to find good stocks or good businesses, you're not trying hard enough, dude. Even in the insurance sector, there are businesses that are in the S tier, and there are also businesses that are in the F tier. You just gotta, I guess, spend a little more due diligence and homework to walk away with knowing like which ones are the best of the best. And I think that's why I really like doing those industry breakdowns, because I feel like had I have just looked at one insurance stock out of context by themselves, by their numbers, I would have been like, dude, this is so good. But once I compare them and evaluated them against their own competition, the ones that are doing the exact same thing, auto insurance, life insurance, home insurance, they were just average. I don't want to give away which company that is, but I think that's why when I do the industry breakdowns, it shows you which 1 or 2 or 3 companies are the only ones worthwhile of adding to a watch list. Because if you only look at a single rate by just their numbers, you might walk away thinking they're so good and they're so sexy. Come to find out, if you compare them to their peers, they're just like a pimple. They're just like tartar on your teeth, plaque. They're not that good. So, I guess I gave away which 2 videos are going to be coming up after I take my rest. So, I'm going to be breaking down the HVAC industry. Oh, and the power utility companies. Sorry, guys. It's like 7:45 a.m. It's too early for this. But let's take a look at their financials before. Oh my gosh. That's pretty good. Ever since the pandemic, they've been crushing. Top line, how's their net income? Okay. Let's look at it visually. I feel like it's, yeah. Wait, what the heck? Why is this graphic all the way up there? But yeah, it's pretty good. How's their dividend situation? 36%. Oh my gosh. I might have to do a deep dive for Centus. This is crazy. A 15% growth rate for their freaking dividend? Oh, what happened here? Oh, okay. at first glance, it looks like they cut their dividend, but they went from paying their dividend once a year in November to now paying it every quarter. So it looks like it's a cut, but it's not actually a cut. Because at first my heart sank. I was like, no, they're a dividend cutter, but they're not a dividend cutter. So that's Centus. Definitely add it to your watch list. If they go on a sell-off, could be a buying opportunity based on, but you know what? They might be overvalued right now. 215 and their price prediction is 216, so there's not much upside to buy into them. But if you can buy into them at 178, when did they hit 178? Oh, okay, last year. Okay, like right there. What about during that April sell-off? 190? Okay. Anyways, let's see what else we got on Thursday, friends and family. By the way, please do give me feedback on this video. I just have too much passion about what I do, guys. I couldn't help myself. I was laying there in bed, and then I was like, you know what? Today's going to be a rest day. And then I opened up my phone, and I took a quick look at what companies were reporting their earnings this week, and then I was like, dude, this is a huge week. So after I took the dogs out, the next thing you know, here I am, I'm filming. The feedback that I guess I'm asking for is, should I do this more often, like every week? This is off the script, by the way. I'm looking at these companies with you in real time. I don't have any notes or anything. So let me know if you like this. If not, I guess silence is a pretty good indicator that you guys hated it. So I won't do it again. But anyways, we have Travelers companies. This was an insurance stock that's featured in the insurance industry breakdown video. The expectation's pretty high. A 34% increase for their net income per share. Oof. But just as we learned with Progressive, I mean, their expectation is a 50% increase. So I guess the insurance stocks, wink, wink, are crushing it. What else we got? Just a bunch of financial and institutions and banks. Okay. And Friday, it's usually quiet. Mondays and Fridays for the stock market tends to be a little quiet. Well, let's see. Oh my gosh, we have American Express. So I sold out of Visa at like a 200% gain, and I bought into AMD, and then I sold out of AMD at like a 30% profit. A company that I really wanted to buy into, but I never had the buying opportunity because I'm one of those people that do not like buying into companies at any willy-nilly price. There's some people out here that do that, right? They don't care. They'll buy into a company when they're at their one-year high. But I just don't operate with that because I like to apply the principles that I learned from Berkshire Hathaway and Peter Lynch, which is to bake in a margin of safety. You don't want to just buy at their highest price because the upside and the downside are against you. But when you buy a company near their one-year low, the downside is smaller than the rewards of the upside. Does that make sense? So let me take a look at my spreadsheet. American Express is on my watch list. Let me see what my buy price is for them. My buy price, based on my research, I got to update this, but it's $230 a share. And it does look like in the past 1 year, they did hit 220. So 230 is not crazy. Like in April, they did hit 230. In August of last year, they hit 230 as well. So this is a very high quality company. I like American Express more than I like MasterCard. I think Visa is the best payment processor. I guess I wouldn't complain buying into MasterCard instead of American Express at the end of the day. I think all three are really good. You can't go wrong with any three of those three. Yeah. And then I used to be invested into Discover, but they got swallowed up and they're gone. They're no longer publicly traded. Now they're part of the Capital One portfolio. There's Ally Financial, which is, I think they're in the portfolio of Berkshire Hathaway. Warren Buffett really likes this one. But it makes a lot of sense. It's a pretty high quality company. And to round it out, let's talk about the last company. It's going to be 3M. They're actually in my portfolio. Funny enough, I bought into them right here. when they're about like $80 or so a share. And I'm up, I think like 90 something percent in the green with them. And I remember at the time, there was so much fear and doom and uncertainty and negativity surrounding 3M. And how long was it? I think for like almost a year, I was pretty much flat. And I was second guessing myself too. I was like, second guessing myself. I was like, is 3M actually a high quality company? But come to find out, after holding on for the past 2.5 years, it turned out better than expected. I'm a pretty happy camper. So 3M is reporting, and I should have sold them a while ago because my price target for them was like 110. And I think they did reach 110 after like a few months of buying into them, but I never sold out of them. And then at that point, I was like, you know what? I'm just going to hold on. This is a high quality company that's not going to disappear. And fast forward a year or two later, now I'm almost 100% in the green. And that's not taking into account the dividends that were paid out. So it just goes to show sometimes it's really good to just hold, like do no action, which is a philosophical takeaway from, what is that? It's a Chinese Taoist, it's Wu Wei, the action of no action. Sometimes just holding on to a high quality company, you'll be okay. You'll walk away better than selling prematurely. And that's basically how it's panning out with 3M. So, I don't know. That just about wraps up the earnings for this week. I can't say enough gratitude and thanks for the ones that watch the videos, especially all the way till the end. So, I just wanted to remind you once again that I love you guys. Thank you for allowing me to do this, to make YouTube videos and everything. I cherish you guys, man, and I hope you have a good rest of your day. Good luck this week. Stay safe, and I'll talk to you guys really soon. See you guys.